endless drivers for people to buy gold. And if one country is buying a bit less, say Turkey, right now premiums have subsided somewhat within the country. It's still a premium market, but not as much as it had been. Demand picks up elsewhere. If retail, let's say in the United States, hasn't been buying, we see greater and greater institutional interest. Of course, gold has always been that kind of market that every different possible group, from Indian workers making a wage of $5 a day to Wall Street giants, everybody is a buyer or seller under the right conditions and at the right prices. But in general, I see nothing good happening in the world of currencies or government finances, which is what the currencies are issued ultimately to do.
To combat inflation, the Turkish central bank has significantly raised interest rates, which are now at 43%. As a result, gold purchases as a hedge have been discouraged, and the Turkish lira has momentarily risen. In addition to decreasing short-term retail demand, higher interest rates increase the opportunity cost of storing gold, which yields no return. Gold's long-term appeal is being steadily supported by global currency volatility and fiscal decline. Central banks are doubling down, investors are reallocating their holdings, and gold's long-standing role as a haven appears to be permanent rather than coincidental. Keith Weiner, an American economist and the founder and CEO of Monetary Metals, sees growing instability in global currencies and government finances. He recalls how, in 2009, fears of hyperinflation led to a surge in gold buying. Global hyperinflation risks, especially in emerging markets like Argentina, Turkey, and Zimbabwe, are driving a surge in gold buying as individuals and institutions flee collapsing currencies. In Zimbabwe, runaway inflation and a currency collapse led the government to launch a gold-backed digital currency, the ZiG, in April 2024. Yet the new token also lost significant value, underscoring public loss of confidence in fiat money and bolstering gold demand. In countries like Argentina and Turkey, where inflation soared past 60% and the peso and lira depreciated rapidly, citizens and businesses have increasingly sought refuge in gold and even gold-denominated bank accounts to preserve wealth. According to the Turkish central bank's estimates, which are calculated by adding the current quarter's gold production and imports to the previous period's stock and subtracting gold exports, households held approximately $311 billion worth of unregistered physical gold as of the third quarter of 2024. Commonly referred to as under-the-pillow gold, this vast stockpile lies largely outside the official financial system. Most recently, as part of efforts to curb tax evasion and money laundering through gold transactions, Turkey had enforced a rule in 2024 that requires customers to present identification for jewelry purchases exceeding 185,000 Turkish lira, approximately $5,274. In addition, the Treasury and Finance Ministry banned the sale of uncertified cut gold bars in March, aiming to prevent untraceable transactions and tighten oversight of the informal gold trade. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
But in general, I see nothing good happening in the world of currencies or government finances, which is what the currencies are issued ultimately to do. So, unlike, say, 2009, when everyone didn't understand QE and said hyperinflation is imminent. I was at a conference in July of 2009, and somebody, a big famous name, I'm not going to say who it is, said that hyperinflation is certain by the end of the year, 2009, 16 years ago. So anyways, people were buying gold to protect themselves from something that wasn't going to happen. And I said at the time, this is not going to end well, because when it doesn't happen, then there'll be a lot of selling, and of course there was. And so we went into this seemingly endless bear market, second half of 2011 through 2018 into 2019. But today, I think the buying is different. It's just, I think, a much greater sense that gold is a long-term holding. I mean, obviously, a lot of people use it as a speculation. You buy it, its price goes up, you sell it, you have gain, great, whatever. But I think there are more and more people that are buying it without any particular price expectation and no particular time horizon to sell it, which is important. First of all, that's the right thing to do because you're protecting yourself against government credit dishonesty. Whether the price of the dollar will be this or that. But it's important in discussing the gold market that these are durable, I guess what they call strong hands, people that are buying it without any particular intention to sell it. And so this is a market where you buy the dips. And you look back, last year I was in Dubai. It was around August. Very, very hot. Not a lot of people want to be there by choice. And I was wandering around the gold souk, which was fairly empty. And there were several stores that had a sign, 0% making charge. So I'm like, okay, is this real? Is this some sort of come on? If this was Canal Street in New York, there's stores that are perpetually going out of business for 30. I mean, the sign that says going out of business is yellowed and frayed, and that sign's been in the window for 20 years, right? So I go in, and I see the price of something. It was a necklace that weighed 89.5 grams. This thing was heavy. I mean, I pity anybody who actually tries to wear it. By the end of the day, you'd have this bloody welt on your neck. And I regret not buying it. Of course, the gold price was, at that time, what was it? I don't know, 300? Something like that. And, a heck of a lot higher now. Maybe it was 24, 2,500 at that point. And it was true. It was a 0% making charge. And the reason is the jewelers are borrowing dollars to buy their inventory, which means they have to hedge, which means they have to short gold in the futures market. And when the price goes up, then they have a margin call. And so they have to liquidate some inventory, and that's what was driving this. Anyways, my point is I regret not buying it. It was truly a 0% making charge. There's a 5% VAT. So you could buy a piece of perfectly nice jewelry for 5% over the then spot price. Spot price has moved up quite a lot since then. And here I am regretting I should have bought that. I don't think anything's weakening it. I think it only gets stronger. Arguably, Turkey is not imminent hyperinflation, as it perhaps might have been a year and a half ago. But that doesn't really weaken the case for gold. It just means the crisis is, and it's more quiescent. The crisis has two phases in a country like that, acute and quiescent. So now it's in the quiescent phase. I don't imagine anybody in Turkey would be thinking that, everything's fine, sell all your gold and invest in lira. An interesting statistic that a Turkish friend and client of ours shared. Turkey has a population of about 85 million people, I believe. The banking system offers gold-denominated bank accounts in Turkey. Now, that's not a sound banking credit because the banks are forced to deposit all the gold with the central bank, who is widely believed to sell it when people are buying gold. The central bank is selling to them to reduce gold imports, which reduces pressure on the currency. These types of countries hate imports because it puts selling pressure on the currency. You have to sell the currency to buy dollars to pay for the imports. Now, if you're lending something, you don't want the borrower to just sell it. Hey, I'll lend you my car for the weekend, and you sell it. And you promise eventually you'll be able to buy my car back. Well, that's not a good plan, especially for something whose price tends to rise, unlike used cars. Anyways, there's 110 million gold-denominated bank accounts in Turkey with a population of 85 million. There was more than one gold bank account per person. So Turkey with gold bank accounts is like America with guns. It's more than one gun per person. I just find that to be an incredible statistic. Say what you will, Turkish gold demand is up, Turkish gold demand is down, and there's more gold bank accounts than there are people. There's no such thing as, they're all going to just sell their gold and do what? They're going to buy a BRICS currency, they're going to buy lira, they're going to buy rupees. What are they going to buy? They're holding gold, because that's what they do. That's how you survive in that kind of monetary regime, and nothing's going to change. It only it gets worse, but it gets worse in bursts. It's not a smooth process of getting worse. It gets really, really bad, and then it backs off just a little bit, and then it gets bad again. Who knows when it gets bad again?
Exactly. Yeah.
And tariffs could probably drive that. Tariffs will make it harder for governments, banks, and corporations to get their hands on dollars to service their dollar-denominated debt. That's going to cause all kinds of gyrations, and local currencies could go down quite a lot in the ensuing scramble for dollars. I have to kind of back up a little bit. There isn't really a disconnect. The price of a gold or silver futures contract and the price of gold or silver metal cash on the barrelhead are basically the same. I mean, if you plot both on a graph, the two lines are on top of each other. They're indistinguishable. You need a very fine precision instrument, which we call the gold basis, to see the difference between the two. But they're off by, if you measure the gold basis, which is the price of the futures market minus the price of the spot market, it's on an annualized basis. So let's say the next contract right now, here we are basically entering August. The next real contract, sort of October. October is not really that great a contract. Call it December. What is that? 4 months away. Annualized, that could be 3-4%, which means the December contract would be, let's call it 1% above spot. 1% is $30. And by the way, that's higher. That is, people are paying more for that paper than they are for the metal. I want to emphasize that, because the theory that says they're divorcing says, oh, people are rejecting the paper, they're repudiating it. Well, the paper is $30 higher than the metal at the moment, and that's called contango. That's normal. That's what the market is supposed to look like when there is no crisis, which there is not currently in gold. And that moves around. It's largely driven by the interest rate plus fear of counterparties. When the fear of the counterparty becomes really great, you get backwardation. We don't have backwardation at the moment. There's not a lot else to say. For people who think that there's this massive short selling pressure on paper suppressing the prices of the metals, that would drive backwardation, which, as I said, is not occurring right now. I wrote what I think is the definitive proof that this is not happening, and it was a response to, I think, the last thing that Ted Butler wrote. Ted Butler said, look, I'm an old man now, I'm retiring, I've given my work to the world, here's my thesis, silver's manipulated, by selling futures, blah, 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 but I encourage thoughtful disagreement. So I wrote an article called Thoughtful Disagreement with Ted Butler, in which I stated his thesis in a way that I think he would agree. I said, okay, now, when you have two competing theories, his is that it's manipulated, mine is that the futures market is an arbitrage market, not a manipulation market. You look for a case where the two theories predict opposite outcomes, and let's find that case. And Monetary Metals, we have licensed data going back to 1996 for every futures contract in gold and silver plus spot with sub-millisecond pricing resolution. It's terabytes of data. And in that article, I don't remember what year that was, maybe 2017 or something, from 1996 to that date, 20 years or 20 some odd years, we looked at every futures contract as it went into expiry and showed that every last one of them agreed with my theory that this is an arbitrage market and behaved as an arbitrage market. And so put that out there as the definitive proof. No, this is not manipulated. Fortunately or unfortunately, it's not manipulated. It is what it is. If you think gold should be 30,000 instead of 3,000, you can buy gold on that thesis, but don't buy it because you think it would be 30,000, but for some nefarious dark cabal. That's not true. It's not going to happen. Anyways, that essay is out there. Every gold site, including the gold conspiracy ones like Le Metropole Cafe, which is GATA's own website, I believe, or GATA as well, I should say, published it, and one of the GATA guys runs Le Metropole, published this essay, Thoughtful Disagreement with Ted Butler. All the data is out there in that article, the argument is out there, and let people, come to their own conclusions.
Keith explains that fiat currency is inherently dishonest because it's not backed by anything tangible, like gold, and is enforced by government power. In a redeemable gold standard system, paper money could be exchanged for gold, thereby maintaining the integrity of the financial system. No modern government currently allows paper currency to be redeemed for gold. The U.S. officially suspended convertibility in 1933 and entirely abandoned the gold standard in 1971, separating fiat currency from any physical backing. Federal Reserve notes now carry the phrase legal tender, meaning they're accepted by decree, not redeemable for gold or any commodity. That said, a parallel system exists in the private sector: gold-backed digital currencies, digital gold currencies or stablecoins, whose value is tied to allocated physical gold in audited vaults. These include tokens like Paxos Gold and Tether Gold. Zimbabwe is also piloting a digital gold-backed currency called USDKG, which is redeemable in gold, fiat, or cryptocurrency. A broader push to reintroduce gold-based digital money is being explored, utilizing blockchain and smart contracts, which could potentially automate redemption and ownership tracking. Keith also takes issue with central banking practices, particularly the use of interest rates to control inflation. He contends that, contrary to popular belief, increasing interest rates raises prices by compelling businesses to sell off productive assets, thereby lowering supply. Conversely, declining interest rates encourage borrowing and investment in manufacturing, which in turn reduces consumer prices. However, monetary policy is being distorted by central bank power struggles and political influences, such as Biden's demand on the Fed to lower interest rates. Keith believes that structural economic forces will sustain the long-term trend of falling interest rates, despite manipulation. Now, let's shift our attention towards the interview.
So fiat refers to government force. The government says, use this as money, or use this as if it were money, because they can't change reality, but they can force you to act as if reality were different, because they have a gun that's bigger than anyone else's gun. But more importantly, in an economic context, the currency is irredeemable. So in a free market, in a normal world, which we do not have, the money is gold. And, they're issued pieces of paper, which are very useful for a number of reasons, that are redeemable in gold. So in the United States, up until 1933, you could deposit an ounce of gold in a bank, approximately an ounce, it was just under, and get a $20 bill. Redeem at any time, either you yourself or you paid that $20 bill to somebody else. You can walk into the bank, no questions asked, and just put the $20 bill across the counter to the teller, and the teller would give you back the gold. So that's redeemability. The most important feature of that is it keeps them honest. I mean, most of the people most of the time have no need to redeem. It's only when either they're cheating in terms of the quality of the credit they're issuing, or someone's trying to put their thumb on the scale and the interest rate is dropped below your time preference. And you say, it's not worth it anymore for this, this set of risks in this banking system. I might as well take my gold back. Well, that's what they ended different countries at different times. The United States infamously in 1933 with, the edict by President Roosevelt. And then after that, everybody's disenfranchised. No matter what they do, you can withdraw your cash. People think of it as withdrawing from the bank, and you get paper, right? And the paper itself is a credit, and it says right on it, Federal Reserve note. A note is a word for credit. So you can either finance the banking system by having a banking deposit, or you can finance the Federal Reserve, who uses it to finance the government and the banking system, or you can buy treasury bonds or treasury bills, which finance, the government and the banking system. You can't really get out anymore. You're disenfranchised. So this allows them to play whatever game they want and make the money, or what they call money, the currency, more and more dishonest. And so what we have is a crisis of honesty. Credit is borrowing, but if you're borrowing without the means or intent to repay, it's a fraud. It's a counterfeiting. And so that's sort of the root of the whole system. So the two problems in irredeemable currency economically that sort of ensue, one is because we pay debts using dollars or euros, and those are themselves IOUs, we pay debts using IOUs. Notice the problem, the IOU, the debt itself is never extinguished. It's merely shifted around like a lump under the rug, which means necessarily, as an inexorable, necessary part of the functioning of the system. Not because the politicians are bad, which they are. Not because the voters want more free goodies, which they do. But because of the functioning of the monetary system, debt must grow exponentially. And has been ever since 1971. So yes, we have record new levels of debt. Every time you interview me, anytime anybody interviews me, the debt is always at a new record. It's growing exponentially. That's what an exponential curve is. So the problem with exponential growth curves, if you look around at the engineering world or the natural world, you find that they don't end well. They end not gracefully, they don't subside gently, they don't go, gently into this good night. They fail in a catastrophic, blow up. Think of a thermonuclear bomb, going off. It's that kind of thing. When that happens is anybody's guess. If you asked me in 2012, I would have said 5 to 7 years. Obviously, I was early, quite early. Here we are in 2025, 13 years later, and apparently still going strong. But there is a finite, terminus to all of this. So the debt grows exponentially. That is a necessary function of the whole thing. And the other is that the interest rate is totally unhinged. After World War II, most infamously, the interest rate was ever rising. By the 1970s, they called government bonds were called certificates of confiscation for the virtually guaranteed and endless capital losses. As every time the interest rate rises, a long-term bond, it loses, value in the market. And then, finally hitting an absurd peak by 1980, 1981, and then reversing almost to the day that President Reagan took office. And so he gets credit as being a brilliant, economic president. It's great fun to be president when long-term rising interest rate turns to a falling interest rate that juices up one hell of a boom, as economists call it, a boom. It's not a good thing, but it was a lot of fun at the time. And we're still in a falling interest rate trend now. Other central banks have begun to cut. The Fed had started. But of course, we have a president who is now ordering the Fed, you will cut. So the chairman of the Fed, Jay Powell, seems to resent that and is resisting that and saying, no, we have this indicator and that indicator and this but that, yes but no, on the one hand, on the other hand. And so, he's dithering. I assume, this is not economic science, this is just reading people. People resent being told what to do. He doesn't think, and most people don't think the president rightfully has the power to dictate interest rate policy. That's not how our particular central planning system was set up. That particular power is supposed to be in the hands of the Federal Reserve Board, not the presidency. But I'll say two things. One, Powell's term is coming to an end, I believe next year. And number two, the forces that have been driving the interest rate down since 1981 are still in full force and effect. And so one way or the other, interest rates are going to come down. In the meantime, the perversity of the whole thing, mainstream theory thinks if you want to fight rising consumer prices, which they miscall inflation, then you should hike interest rates. That is exactly the opposite of what you should do. There are many, many harmful effects of falling interest rates. But if your only care was consumer prices, you should want falling interest rates because that means fresh, new, every time the interest rate ticks down is an additional incentive for every producer to borrow more to finance more productive capacity. And conversely, every time the interest rate rises, that renders some productive asset submarginal. It has to be liquidated. And we're in that phase now, as you see, companies failing, trying to, divest of assets. Ultimately, assets are going to have to get shut down. And so if you want higher prices, have higher interest rates, because corporate, return on capital is driven by, the interest rate. You can't have the return on capital below the cost of capital. And so, with return on capital, comes margins. Margins ultimately reflected in prices. So we are seeing, have seen an uptick in prices due to that, and of course due to, everything from COVID, lockdown and whiplash, to green energy policies that have made energy, in the UK about 10x more expensive what it was. I don't have the exact prices in Germany, but a lot higher, right? And then tariffs, which are driving prices higher, but with a variable lag.
Keith Weiner concludes by noting that growing inflation, global currency instability, and a growing mistrust of fiat money are rekindling interest in gold as a trustworthy store of value. To protect themselves from financial instability, governments and people from Turkey to Zimbabwe are using gold-backed securities and physical holdings, while conceding that contemporary digital gold tokens may provide a way forward in today's tech-driven society. Weiner criticizes current central bank policies and advocates for a return to more transparent monetary systems, such as gold redemption. Could digital currencies backed by gold replace fiat currencies in countries with high inflation rates? Is there a better way to control inflation than Keith Weiner's critiques of central bank interest rate policy? Please share your thoughts in the comments section below. We'd be delighted to hear them. Don't forget to subscribe for more videos and give this one a thumbs up if you found it helpful. We appreciate you sharing in our adventure.